Today, we're going to look at how to invest at record highs, and we have obviously a new structured product to show you guys today as part of our Under the Microscope series. And what we're going to do is take you through really the basic mechanics of the Rand Swiss Triple Index Autocall. It's very similar to the Autocall that we ran last month. So we're doing this as a short form clip. It'll only take, it'll take a lot quicker than a full webinar. You guys will probably be watching this on YouTube. If you haven't, like and subscribe. We're trying to get the subscribers numbers up because then we get all sorts of good things from YouTube, I think. We're going to take you through basic mechanics of the product, why we use structured products. We've got some back testing. We just want to discuss credit risk. And then obviously the next step to actually investing in the product as well. This product is obviously me and Viv today chatting about it. And this product really fits in our managed solutions. So we're kind of trying to explain what the product does, why we use it, how we use it, and we're trusting you to judge whether or not it's appropriate. If you feel that you'd like to know more, but you're not sure how it fits into your portfolio overall, I really would speak to one of our wealth advisors, get in touch with one of the representatives on the desk. They will be more than happy to put this in the context of your overall financial portfolio. They'll be able to say how much to invest in the product, what is appropriate for you to invest. But today we're literally just talking about, the pros and cons, when to use it, when not to use it, and how these things work. Of course, we, like I said, speak to our wealth managers. We've just run top boutique wealth manager of the year. Okay, and what is a structured product? Viv, you want to take it from here? What is a structured product?
So the basic way I look at it is as this. A structured product is a product designed to achieve a certain investment purpose. It's like the example I use is a cave versus a house. A cave can be used for shelter. A house is purpose-built for the process and therefore has exactly as many rooms, many bathrooms, etc. as you need. A structured product is the same way. You see a situation in the market and say, this is what I think is going to happen. How would I benefit in this scenario? And then you create an investment that will react in the way you want it to react, have a payoff profile. Often it involves guaranteeing a certain amount of your capital at the expense of giving up some upside. This is the usual structure of structured product, and this is what the structured product we're going to use today is going to look like.
Okay. So the structured product today, really, like I said, very similar to the structured products that we use normally. So we're linking the product to the S&P 500, the Nikkei, and the Euro stocks. We actually had an option on the NASDAQ. It was going to give a slightly higher coupon. So we're looking at around a 12% coupon per year, simple interest on this one. We have actually already started pre-hedging because this is a roll product. So we actually did this exact product a year ago. We're cashing out of the product at the moment because all the indices, we've had a very strong year in markets. All three of these indices are positive over the last year. So this is the first observation. Everyone at that stage is getting, I think it's a 14% coupon that we achieved here. So, the markets have changed a little bit. Markets are a lot higher than they were. Volatility has changed. The price of the options have changed. Interest rates have come down a little bit. And that has squeezed the coupon. So we always market at 12%, but I can say we've already started pre-hedging for the book that is rolling into the next version of the structured product. And we've pre-hedged at a 13% coupon. So it could be a little bit better. Like it'll always be better than 12%. We will not release the product if it's not better than 12%. But any benefit that we get, our fee is fixed essentially. Like there's any benefit we get on the actual execution, we will move straight across to you as the client. And like I said, we're hedging at about 13%. If we can get, once we've completed all applications, which are going to close on the 8th of December, once we've completed all applications and we've done the rest of the hedge, we'll get the exact number. And of course, we're going to try and get it above 13%. We're going to try and squeeze the banks for everything that they're worth, because obviously we want the highest coupon that we can get. The duration is 5 years. As usual, when we talk about autocalls, that's the maximum duration, and we have these observations that go through, and we keep observing it. The shortest it can be is a year. The longest the product can run is for 5 years. The capital protection is at 30% on this product. And like I said, this is actually a product that we're rolling from a previous product. So all of those clients that essentially now get to reset their capital protection again, and extend their duration for an extra year. So it is something, and also we get to compound the interest, which is lovely. 12% or better. And it's going to have, when we say 9 chances to win, we delay the first observation for at least a year because we want to at least make a kind of 12 to 14% coupon. But from there, we do semi-annual observations to try and give you as many as many possibilities of exiting. Viv, I don't know, from your side, I mean, the reason, maybe, anything that you're picking up there. I mean, the reason that we do semi-annual observations and not, delay for 3 years or anything, or, I mean, maybe also the choice of S&P over, S&P, Nikkei, and Euro stocks. I mean, what's the thinking behind that?
Okay, so firstly, you notice that we've changed our view on these structures over the last couple of years and doing a lot more autocalls at the moment. The reason being is that the world has turned a bit more volatile. I mean, things like, for instance, of course, COVID, we all know about that, but even like the Russian invasion of Ukraine, the possible down the line in China's invasion of Taiwan, who knows what the future holds, the Trump election and the tariffs that are coming to play, Liberation Day. We're living in a much more volatile world. So the reason we have 9 opportunities is because the only time our structures have ever had any issues in the past, and look, we've only had one structure historically that's basically a returned capital. Actually, two structures historically.
Sorry, can I just tell you, when he says issues, he means they only returned capital.
Yes.
We've never had a loss.
We never had a loss in this thing.
We've never had a loss on a structure in 10 years of doing this. But for us, a giant failure of a structure is, oh no, in a falling market that was down, the one market, I mean, we caught it in the teeth of COVID.
Yes.
I think if you had bought the ETF, if you had bought the stock market, you'd have been down about 18%.
Yeah.
We gave the investor their capital back.
Yeah.
The insurance essentially kicked in. So just what you mean by failure of the product. But yeah, so.
Exactly. But I mean, in those circumstances, a few months before and like a few months after, these products would return profits. The problem is that, with one date for basically maturing, you can hit these weird events like Liberation Day, like what happened with the COVID. Like I said, we think in the next maybe 5 years or so, there's a serious chance that Taiwan is invaded by China. Who knows what the future holds? And so by having 9 days, unless it's a huge trend that lasts over 5 years, the chances are you're going to get a day in those 9 days that's going to be, giving you your money back, plus a profit. And so that's why we choose multiple days. The next thing is that why we chose the S&P 500 versus the NASDAQ, even though the NASDAQ gave a slightly higher return, is historically the NASDAQ has a worse history of basically crashing and remaining lower than the S&P 500 does. And in the current environment, quite frankly, I mean, it doesn't take a rocket scientist to understand that we are in a very unusual time in history. The one thing that people always go back to is the dot-com bust of, say, the early 2000s. And if we were in that scenario, I mean, the NASDAQ obviously reacted more negatively than the S&P 500. The other indices we have there, the Nikkei and the Euro stocks, are not quite as linked up to the issues that we have with regards to the tech boom that we're seeing currently in the US AI sector. But historically, at least until after 2008 or so, have been reasonably stable. And the correlation that they've had with the S&P 500 has been quite high in terms of positive or negative moves. And one of the things that we do by having multiple indices that are well correlated is that we're able to get a higher return for a lower actual risk profile. And that's one of the things that we've done here is that we try to get the best return we can, 12+%, for the lowest possible risk profile we can create.
Yeah. So yeah, a little bit more on the mechanics of it. So this is, of course, we don't always do fully offshore. So we actually did a locally listed one. We sent out SENS announcements on it, which is quite cool. But yeah, a lot of ours, as I said, a lot of our products are fully offshore. So you will need to use externalized funds. We can provide you with an offshore custodian around that. We use DMA, Velocity, Swissquote. We can use Ramsey, Crookall. There's a whole lot that you can use. But kind of Swissquote, Velocity, and DMA are probably our preferred. Yeah, so sits offshore outside of South Africa entirely. It can sit inside endowments as well. So if you have a global life plan from Glacier or the Momentum, or at least the Old Mutual IP Plus plan, for example, or any of the international endowment wrappers, it can sit inside that. Yeah, minimum deposit size is $20,000. As I said already, the closing date is going to be the 8th of December because we're essentially getting our cash back from the previous one on the 6th of December, and we'll be going straight into the next one so that there's obviously as little time as possible for cash just to sit in a bank account earning interest. we want to try and get that deployed for clients that are rolling. And I think the rolls have been pretty good. I mean, I think we're sitting at probably clients that have invested that are opting to take the product again is probably sitting at like 95% at the moment, which is excellent.
Yeah.
And it just, I think it also just goes to show that people that have invested in the past, they are happy with this product. It really does what it should.
And this is the third roll, actually.
And this is the third roll of
Yeah.
this product as well, which is great. We're looking at an A-rated investment bank, so it looks like we're probably going to go with BBVA at the moment because that's where the pricing is. But yeah, we'll always take an A-rated international investment bank. And remember, South Africa's credit rating, as much as we got an S&P upgrade, which is awesome, we are still junk status as a country. So these banks, have significantly stronger credit rating than even our sovereigns. So we don't look at anything, even with a B rating. And yeah, so that's that. And I think, I mean, this is really a slide on correlation. So these are the three underlying indices that we're looking at. And I think what are we showing here? Really like how these indices move together.
Yeah. And also, remember, this all has to be positive at the same time. And so we can see that generally these markets move together, and therefore you're not going to get or less likely to get the chance where two of them are up and one is down, which is going to be obviously giving you the negative return despite the overall market being positive. Here, these indices tend to move in the same direction. The linkages are coming through, especially with regards to things like interest rates, because if the US is lowering interest rates, the Europeans are also going to lower it, global interest rates are going to be lowered, et cetera, which is going to help, obviously all these indices. I do think, often when people look at pricing of these indices, they look over too long a period of time because the world really changed in 2008 after the financial crisis. We have a much different behavior from central banks in terms of what happens when the market falls. They're much more willing to cut interest rates to get down to very low interest rate policies, and that obviously is much more towards stabilizing for most markets out there.
And I think that's an interesting point as well. So, and I think it's also, we quite often get asked, the two things is one, why don't we have China in this? And China really, because China reacts as a very different market. And what we're trying to achieve with this is correlation. We want all these indices to behave the same. And to the other one is around Japan as well. I mean, why do we have the Nikkei in there? And I mean, we're obviously seeing a whole lot of things coming out of Japan at the moment. And it really has been our base case, for the last, let's say, 4 years, that the yen has to weaken. And if the yen weakens, remember, we're pricing this index in yen as well. So if you get a much weaker currency in yen, that typically is going to force up the Nikkei in a big way. And it's played out exactly as we expected. And, with I suppose, the debt to GDP that we're seeing in Japan, the highest anywhere in the world, we can't really see a way where that's going to uncover. And as you say, central banks step in, these central banks behave in a similar way. And I think from my perspective as well, that's wonderful for the underlying indices, which it gives us a higher probability of these being positive at some point in the next 5 years. But at the same time, if central banks are cutting interest rates, which is kind of where we're going. I mean, there's an 87% chance that the Fed cuts interest rates on the 10th of December. Remember, a component within these structured products is essentially the bond as well. And when interest rates are falling, capital values are lifting as well. So, and you might, in a structure, your return is going to be defined. But as a comparable product, when you buy this and you suddenly look at it in a world where interest rates are 2 or 3% lower, suddenly this relatively is a lot more attractive because you're going to be getting a 12 to 14% yield in a world where you just won't be able to achieve that anymore. So we do like the idea in a falling interest rate environment of, this is really the time to pick these things up. Because I can tell you in 2 years' time, when we're coming back to you going, we're thinking of doing an autocall, but we can only get like 9%. You guys are going to go, why can't you give us the 14 that you used to? And they're going to say, well, interest rates are lower.
And you can see that going back to in history, look back to products we had like before 2020, and often we would be getting like these 9%, 8.5% as reasonable returns on these structures. It's just that the high interest rates, because of the inflation, burst we had recently, has helped get us higher returns.
Yeah, and I think, and that's important as well, because I mean, then typically we will then pull back on the auto calls. We might need to go back to growth notes. There'll be other investments that we'll have to look at, but right now these are the things that are working and really going well. So we've just given you a quick return overview for those that aren't sure, and essentially we've talked a little bit about the mechanics already. But what happens is, as I said, you've got these kind of 9 observations, and those 3 indices that I've just showed you. All you need is all of them to be positive at the same time. So as long as at the first observation, all the underlyings above the autocall trigger, we always put our trigger at 100%. So, on the 8th of December, we're going to observe where all the markets are. Well, I think we're actually going to do it on the 12th. So applications close on the 8th. We'll observe the market on the 12th of December. Wherever the index levels are there, we set those index levels. We set our trigger at 100%. In 1 year's time, as long as the market is higher than that, this will cash out and you'll get your 13% coupon. If it doesn't, then we go down the curve and we wait another 6 months. Then if they're all above 6 months later, hey, you get your capital plus the next coupon. If at the final observation, so if after 9 chances the index is still down and we haven't triggered yet, that means that one of these indices or 2 or 3 of these indices are down. We generally look at the rule is we now look at the worst index, whatever that is. That's the one that will measure against the capital protection barrier in year 5, and there the loss will be taken on a 1-for-1 basis. So let's say that the S&P over the next 5 years ends up 20% negative, that we just have an absolute, it could be that the market collapses and just stays down. It could be that it goes up, but then has a massive collapse just at the end. It could be a big collapse now and a slow recovery and just doesn't recover long enough. There's many routes to that world. But in that case, if the S&P was down 20%, we would come and say, what a failure of a product. This was terrible. All your S&P ETFs, all your stocks are down, but hey, at least we can give you your money back.
Yeah.
That's essentially what it is.
And in dollars as well.
And in US dollars. This is not a quanto or anything like this. Like I said, fully offshore, putting offshore dollars in, you get offshore dollars out. This is a dollar return as well. And and then the kind of catastrophic situation that we talk about is that in 5 years' time, if we were down more than 30%, but obviously we do back testing on these things, which I'll show you a little bit later on. But I think it's about, I don't think, looking at the time period we looked at, there's no period in which we would have triggered a negative return. Sometimes you trigger capital protection. It's about, I think, 2% of the time. But never. But that's essentially the risk that you're taking on the
This is obviously history. History doesn't always reflect the future, but the best we can do is look at what the history looks like and say, if something never happened in history, the chance of it happening, in the next, say, 5 years is unlikely. That's what makes it a good bet.
Yeah, and as we were chatting about it 2 days, it was actually last night about it, and we said one of the reasons that we do like these autocalls is what you're doing is you're taking the most likely scenario that markets kind of toddle along, and you're enhancing a client's return there. Or markets end slightly negative, you're enhancing the client's return there. The only world in which this is going to underperform like an equity, a market-related equity investment, is if markets are very, very strong. Then you will get your coupon at 13%. So you'll still get a return that is probably 1.5 times better than the S&P 500 average, but you're not going to get that. You're not going to shoot the light out, because that's how we're paying for the exposure. But in any other situation, you're going to get either better or equal to market performance, which is for us is that's a pretty cool investment, because don't lose money.
Warren Buffett just retired, didn't average, to call it like gigantic returns. He just basically made sure his returns were a little bit above the S&P 500 every year, and that compounded over time, and that give you the better return that you're going to get. Getting a 14% average return or 12% average return in dollars over multiple years, that is a very, very good way to outperform the market.
100%. When markets are bad and everyone else is slowly recovering, for you to suddenly have a positive year there, awesome. Or even a year where you just don't lose money, but then can take your money back and redeploy while markets are weaker, that's also excellent. So why use structured products?
Capital protection in volatile times. Markets at all-time highs at the moment. You can look at the P ratios, look at what the discrepancy is between the bigger stocks and the smaller stocks. All these things indicate that we are in times that historically, again, have been more volatile times. And in those times, just basically buying into the market directly sometimes is not the right thing to do. Buying it in 2007 and 2008, you eventually do make your money back, but obviously for those multiple years where you didn't get back above the level you bought at. So getting into a market protected product when markets look like this, in like I said, all-time highs, weird ratios in terms of biggest to smallest, biggest share going to certain companies, etc. Those kind of things, having a protected product in those times are very, very historically good.
And I think, just to add to that, I mean, obviously this depends a lot on who you are watching this. Like, what is your specific situation? If you're a more conservative investor, definitely something to look at. But I think even for someone that is a more aggressive investor that is willing to ride out volatility, there is definitely, in the market situation that we're in, there's an argument that these products will allow you to be opportunistic, because in what you're actually hoping for here is the market to end 30% down, so that if you think about it in a relative, with your relative manager hat on, if markets are 30% down and you can have a product give you all your cash back and allow you to redeploy into the market at a much, much lower level, that significantly enhances your return over time. So it's both for more conservative investors or investors that are concerned about markets and looking to be opportunistic around that. So yeah, enhanced returns, I think we've talked to death about that. Obviously structured products, you can access markets that you wouldn't normally access. I mean, we have chosen quite vanilla instruments at the moment, although there is kind of a speculative one that we've got on the table that we still have yet to launch. But yeah, and then obviously we can tailor these to your specific strategies as well. So, it's not as expensive as you would think. And especially if we just club a couple of different investors, if you have an idea where you say, guys, what I really want you to build for us, I need something that's got this much protection and I'm looking for this, and these are the indices I want to do it, we can actually just build it for you bespoke. So that's one of the nice things about structured products. You were talking about Warren Buffett earlier. Don't lose money. Don't lose money.
If you just never lose money, then over time you will be better off. That's just the way things go.
Just don't lose money. Don't lose money. So buying at all-time highs, we've also chatted about. So this is just an example of, and again, it's difficult to tell what the path is going to be of these instruments, because markets are uncertain, the future is uncertain. Like, as much as we predicted the crash, we said markets are going to go out 20% and finish at all-time highs. It was a great prediction at the beginning of the year. Great prediction. That's a guess. I mean, we can't, as much as we were right, we can't really claim it. But this is an example of where these products really work well. And this was buying essentially at the highs in 2022. We had clients that bought a structure in that situation. And I think it's illustrative to think about it. Essentially, you went into the market and immediately 2022, the markets just went down and down and down and down. And they started to recover kind of in the beginning of 2023. But at the first observation, you could see all three indices were negative. So instead of calling in this product and giving you your let's say 12 to 14% coupon, it rolled over to the next observation. The next observation was 6 months later, July 2023. And we went for that observation. At that stage, we had one of the indices positive. The other had actually just crept positive there, but we still had one index that was negative. We rolled over to the next one, third observation. Now suddenly, like, this market was doing okay. Finally, we kind of cashed on the fourth observation. Essentially, that's 1 to 2.5 years later. So we got about halfway through the term of the product. Now, obviously, like let's just say hypothetically at a 12% coupon, the investor gets 12 plus 6 plus 6 plus 6. I mean, compared to a market return that if you had bought a basket of these three indices, I mean, you would have been nowhere close. This way outperformed the weighted average of these three indices. So I think that's where, like, you see a really decent return, and it's also quite illustrative just of how the product works. For this investor to have lost money, these indices would have had to, over a 5-year period, collapsed more than 30% and stayed down, which is a very unlikely situation. And here's some scenario backtesting. So this is the backtesting I was talking about. So this is measured over. So about half the time we expect this to cash in the first year. We expect to roll every year 52.7% of the time. And then there's kind of like your spread of probabilities going out. And so I said about 2%. So it's almost 3% of the time you would expect the product to fail, if you want to put there. So, I mean, we've launched over the last 10 years, what I think I said, look, we've launched about 50 to 6 different structures, and we've had
Two return cash.
Two return cash. So
never lost any money.
And never lost any money. Yeah. So I mean, I think we've got 46 more structures to launch, and then we'll be on average, and we can have one more that returns cash. And then that's kind of like how you would imagine it. So these are, the probability is very low. In the time horizon that we're looking at the moment, has never breached the barrier. None has ever left. But of course, as Viv says, times are different, markets are different, things can be significantly different. We don't know what the future holds. Maybe the market crashes 90% and never recovers, in which case your Autocall is probably not what you're worried about.
Yeah, that's the thing. Like, if you have any investment, the Autocall generally is going to be safer, because the Autocall is going to have many circumstances which it does not perform as badly as your other investments, and that's the main thing here. There's also many circumstances where it performs better than your normal investments. There's a small number of circumstances where it actually underperforms your normal investment, in which case your other investments are going, like I said, more than 12, 13, 14% a year on average.
Market's down 90%.
Yeah.
World is over. You're hunting for food.
Everything else is failed as well.
Not just your investments. It's Mad Max land. But credit risk. Like I said, we only take kind of AAA credit risk. So just remember, essentially, as much as a structured product is, a bond and some options, and it's a structure that is being created for you, you do take on a counterparty risk in that of a bank, that it is a bank's promise. What that means is that, like I said, the bank has to survive as well. And typically, a lot of clients start to kind of like worry about credit risk as well as soon as you tell them about it. They never knew what credit risk was until you told them. But yeah, essentially, like, it's one of the reasons that we do sort of suggest to clients that we build up a portfolio of notes in a bank, and we do try to vary them. So the Autocall that we did last month was a Barclays note. Like I said, it's leaning towards this is probably going to be a BBVA note. Here's BBVA, as you can see, S&P rating of A. You've got a Moody's rating of A3 plus, Fitch's A minus. So BBVA, outlook is stable, and essentially you build up a portfolio of these notes. You mix up your counterparties, but really BBVA would have to write their share price down to 0 before you lost money. It would have to be banking failure, and I think we were talking about that the other day as well. I think the post 2008, the new requirements around banking is very different, and I don't know if the markets fully grasp that. You will say anything on that?
A couple of things. Firstly, to give you an idea like what banking risk is, if you have more than a couple 100,000 rands in a South African bank, you're taking more risk than you would be in this thing here. Because South African banks, by definition, are more risky than any of the banks are on our potential list, because the South African government itself is more risky than any of the bank's potential risk. And you can't build a bank in a country that has a lower credit rating than the bank. It's just not possible. It's like you can't build a house stronger than its foundation. You can't build a bank stronger than its country. So all our banks in South Africa have a lower credit rating than any of these banks. And if you're willing to put like a couple million rands into any bank in South Africa, the bank account, you are taking more risk than we're talking about here. Just to give you an idea of what we are talking about in terms of the risks of banks. Yes, banks do go bankrupt. Okay, we've had such situations in South Africa where the banks have gone bankrupt, or some banks have gone bankrupt. But if you're not, upset enough about that, in order to put like, a couple million rands into an Absa or a Standard Bank or something, that is the same kind of level of, I think, concern you should have here. Okay.
Okay. Yeah. And I think, but like also, like, just from my perspective as well, like the banking credit risk also informs the coupon as well. So the riskier the bank, there's nothing wrong with buying, a South African bank note, but you must be compensated for that. You can't get a 12% dollar return if a South African bank is writing you the structure. The exact same shape from a South African bank must give you 18%. Also it must be significantly higher than what you're getting now, because you're taking on that additional risk. And I think what I was kind of referring to earlier is that also with it, I suppose the changes after 2008, I think a lot of people look at like the Basel requirements, and you almost achieve a higher coupon. There's maybe there's more perceived risk than there actually is, which means that you actually get a higher coupon than you probably deserve. Yeah, and I would say that's one of the reasons that we like these things at the
We don't
moment.
tend to have banking crisis happening this soon after the last banking crisis, because
Exactly.
when the last banking crisis happened in 2008, the laws were changed to make sure that it doesn't happen again, and the banks have a much higher amount of reserves they have to keep, much more sort of safety they have to be, having their, or much more fat they used to have in their calculations. And those things mean that, having a bank, default to a level in which you are going to be affected in these structures is much less likely than it was before Basel III.
But you do get to also get a higher coupon for free.
Yes, exactly.
Which
Exactly.
I like. I like that. It's always nice to get a bit more
Yeah.
of a bank than you should. Okay, and then yeah, I suppose also just timing it at the moment. So we're trading around 17.12 to the US dollar at the moment. So we did a little bit of just a little technical chart for you guys. I mean, we're kind of heading into this kind of resistance zone over here at the moment that we saw second half of 2024. Typically, the December period, has historically been very good for the rand. We've had a very strong rand over the Christmas period. I mean, I've seen the asymmetry between importers and exporters. Our exporters shut down, but our importers keep importing over the Christmas season, and it's one of the reasons for the skew. The other way around, yeah. But like that, sorry, the exporters keep exporting, the importers shut down. Yeah, but yeah, that's one of the reasons that I've heard for the skew. Whether that's true or not, like who knows? I mean, the market is anonymous and super liquid, but there's a statistical trend that the currency is a little bit stronger and tends to weaken in the first half of the following year. So it does look like a fairly good time to be exiting. I mean, I know I bought some foreign currency today, and I suppose the key thing is your single discretionary allowance. If you have rand that you're looking to move out, you've got about a month to go, and then you lose that allowance as well.
Yeah, and just to I mean, you can go back yourself and look at the charts on the rand and look at the price at like near the end of December till maybe it's not around February to March, and you usually find the February March level of the rand is weaker than the level at the end of December.
Exactly right. Yeah. So yeah, maybe a little bit of nice entry point on the local currency. If you are, of course, if you've already externalized funds and you're just paying across into the note, there's no issue with that either. So that's us. Thank you very much. Obviously, no questions today because it's just a YouTube video. But if you do have any questions, I mean, just pop us an email at support@randswiss.com. Of course, you can get hold of us anytime if you do have questions around the structure. If you are looking to invest, what do they do, Viv? They
just contact us.
Email support, phone that number on the screen. Speak to your dealer. Like this is probably going to be for most of it. Like I said, this is mainly for existing clients.
It's quite a short time.
Yeah, because it's quite a short time, but it was not even that's a short time. It's just one of the things that we're doing for the client base into the end of the year. But yeah, pop us an email and support. Say, hey, I want to find out more about your structure. You can book a meeting with one of the representatives. If you have specific questions around the construction of the note, I mean, feel free to reach out to me and Viv. And yeah, have a good day.
Thank you.